John Steinbach has lived in the same house for nearly 40 years. So when his January electricity bill arrived, he assumed he knew roughly what it would say. It said $281. The month before, he'd paid about 100. Nothing in his house had changed. He wasn't running anything new. The reason his bill nearly tripled had almost nothing to do with him. It had to do with a wager being placed thousands of miles away, one he never agreed to, and probably never heard about. That wager has a number attached to it: $2.5 trillion. Now, let's be precise because the number gets thrown around carelessly. 2.5 trillion isn't one signed check. It's a forecast. The research firm Gartner projects that the world will spend roughly $2.5 trillion on artificial intelligence in 2026 alone. What's stunning isn't just the size, it's the speed. That's a 44% jump in a single year. And here's the quiet irony. Even Gartner says the technology has slipped into what they call the trough of disillusionment. The world is spending faster than ever on something it's also starting to doubt. So what happens if the payoff never arrives? To understand the stakes, you have to understand how much the economy is now leaning on this. Harvard economist Jason Furman crunched the numbers for the first half of 2025. Data centers make up only about 4% of the American economy, but they accounted for the overwhelming majority of its growth. Furman is careful here. He's not saying the economy would be at zero without AI. He's saying it would be growing maybe half as fast. Still, think about that. One narrow slice of spending is doing the heavy lifting for everyone. And data centers, once built, employ almost no one. So the question becomes uncomfortable. What happens to the rest of us if that one beam cracks? To see the crack, you have to meet the players. Picture a small circle of giants: the chip maker, NVIDIA; the AI labs like OpenAI; the cloud builders like Oracle. Now watch how the money moves between them. NVIDIA announced plans to invest up to $100 billion in OpenAI. OpenAI signs a roughly $300 billion cloud deal with Oracle. Oracle then turns around and buys its chips from NVIDIA. Notice what happened. The same companies are each other's investors, suppliers, and customers all at once. Critics have a nickname for this. They call it the infinite money glitch. Because when an investor hands a company cash and that company immediately spends it buying the investor's product, the investor gets to record it as revenue. The growth looks real. The demand looks real. But some of it is just the same dollars walking in a circle and changing names along the way. And once you've seen the circle, you can't unsee it. You start asking, how much of this boom is actually real? That brings us to the part nobody in the circle likes to discuss: the math. The consulting firm Bain estimates that for all this spending to pay off, the AI industry would eventually need to generate around $2 trillion in revenue every year. Now look at OpenAI, the company at the center of it. In 2025, its revenue was about $13 billion. Against commitments like that $300 billion Oracle deal, a $90 billion deal with AMD, and a $38 billion deal with Amazon, the company's own finance chief has reportedly worried out loud about whether it can pay for what it's promised. And it's not just the labs. An MIT study found that around 95% of company AI pilots delivered no measurable impact on the bottom line, though it's worth saying that finding is hotly contested. Here's the first real crack. Even the people placing the bets are getting nervous. Remember those announced plans for NVIDIA to invest up to $100 billion in OpenAI? Reporting suggests that figure has quietly been scaled back. When the deal makers themselves start hesitating, you have to wonder what they're seeing that we aren't. And this is where a tech story becomes everyone's story. Because increasingly, this bet isn't funded by spare cash, it's funded by debt. Goldman Sachs found that AI-related borrowing crossed $200 billion in 2025, about 30% of all new corporate borrowing in dollars that year. Senator Elizabeth Warren has warned that this debt runs through private credit funds and the banks behind them, and tech is now roughly a third of the entire stock market. So if AI stumbles, the damage doesn't politely stay in tech. This is the scenario that worries researchers at Vanderbilt. A correction starts in one sector. Then it spreads through the debt, through the banks, through everything wired together, into an economy-wide crash. The way a housing problem became 2008. One analysis found this build-out is, by one measure, frothier than the 1870s railroad boom and the dot-com bust. So, is a crash just destiny? Not so fast, because plenty of serious people say this is nothing like 2000. Back then, the dot-com telecoms borrowed recklessly and had no profits. Today's giants are different. Google's search business and Meta's apps throw off enormous cash, and they're funding much of this from that cash, not debt. At the dot-com peak, Cisco traded at over 100 times its earnings. Nvidia trades at around 25 times forward earnings. And the optimists argue the productivity gains are just slow to show up, the same way computers took years to prove their worth. But here's the twist. Even those reassuring profits are disputed. The investor Michael Burry, the man who famously predicted the 2008 crash, argues the giants are stretching the accounting. AI chips, he says, go obsolete in 2 or 3 years, but companies are treating them as if they last 5 or 6. By his estimate, that quietly understates costs by around $176 billion between 2026 and 2028, possibly overstating Oracle's and Meta's profits by roughly 20 to 27%. Nvidia has formally pushed back. But if even the proof that it's fine is contested, how is an ordinary person supposed to know? Here's the honest answer. The $2.5 trillion bet was never one bet. It's millions of them. A crash is a real risk, but it is not a certainty. And the whole thing hangs on a single question. Will AI revenue ever catch up to AI spending? Nobody knows yet, which brings us back to John Steinbach and his electricity bill. Goldman Sachs expects household power prices to climb another 6% through 2027, driven by these data centers. In 2026 alone, lawmakers in more than 30 states have introduced over 300 bills about them. You didn't place this bet, but you're already paying the down payment. So here's the real question to sit with. If you're already paying into the wager, whether you like it or not, do you want it to pay off? Or pop?